if you're getting into a property right now that maybe 3 years ago when you just started thinking about buying a property, you were calculating your mortgage payment at, let's say, 2 grand, 2,300, something around there, and today it's almost double. So I'm going to talk about the world of real estate investing in the GTA right now, where interest rates are at an all-time high and payments in some cases are double, if not triple, what they were 2 years ago. There are some solutions and I'm going to go over them and how you can use them to your advantage if you're in such a situation or if you're looking to get into your first home or get your first investment property. So these things can really make a difference and they can cover almost half of your payment if you do them the right way. So just listen up and listen closely. So as of today, variable rates are probably sitting somewhere around 6% and fixed rates are somewhere in the low 5s. We go back to 2 years ago and we were getting rates at around 1.5 on a variable and 2% plus on a fixed mortgage. So things have drastically changed. So I would say for the most part, a payment that was about $2,300 is now sitting close to $4,000. So that would be an $800,000 house. If you're going up to $1 million, you can add another $1,000 to that. So that's kind of where we're at today in terms of affordability. Now, for a lot of people, that simply does not work because it's just not affordable. Your income can only stretch so far, especially in the course of 2 years, but your expenses, if they're rising at such a high cost, it just simply won't work. Now, the other issue we have on the other side of that is we have low inventory, so prices aren't really going down to reflect the new high interest rate environment because people just simply don't have enough houses to buy. So people are competing over the same properties. So I'm going to tell you how you can kind of use this to your advantage because that same issue is also occurring in the rental market. So obviously, as private landlords, investors, the only advantage you have when you own a property is you can make changes to it that obviously you're going to pay for and you're responsible for, but you're allowed to take advantage of that by adding secondary units and renting them out. So right now, because of the same exact housing crisis, there's not really enough units for even renters. So rental rates have gone up, I would say 30 to 40% since pre-COVID. A lot of units that were renting out for $1,600 are now going for $2,200 or more in some cases. So this actually works in your favor because what you can do is if you're getting into a property right now that maybe 3 years ago when you just started thinking about buying a property, you were calculating your mortgage payment at, let's say, 2 grand, 2,300, something around there, and today it's almost double. Something that you can take advantage of to offset that is basically you can get half of that paid by renting it out, right? So if you have a secondary dwelling unit, for the most part, they're renting out between $1,500 to $2,500. So in a lot of cases, that'll cover half of your payment and it'll wipe out any additional costs that you have and let you put 20K plus in the bank every year. Single family homes no longer work, right? By single family, I mean properties where you just have one unit, even if it's including the basement, including the upstairs, whatever's on the property. So there's no second kitchen, there's no possibility of someone else living there. Now, those used to work a long time ago. They actually stopped being, I would say, they were no longer really affordable a couple of years ago in the GTA, but even 1 hour outside of the GTA nowadays, it just simply doesn't work because the mortgage payments are much higher, right? So the positive is because the rents went up, most areas, like I said, you can rent out your basement or a secondary dwelling unit anywhere between $1,500 to $2,500. So the way that would work out is you would either have a basement unit in most cases with a separate kitchen. Ideally, it's legally done, and most cities will allow you to rent that out, and you're covering pretty much all of your expenses there. So that solves all your problem. And the thing is, you don't have to use that as the permanent solution. So that's a great stepping stone because if you're just getting into the market and you still have your down payment you've been saving, but you're just kind of weary of what's going on, The good thing is right now prices have gone down quite a bit, and I don't think things are really going to change for at least another year or so until rates start coming down. So you can take advantage of the low prices, offset your costs, and use this as a stepping stone to build some equity. And then eventually, as you're saving more money because you're getting that additional income, you can put that aside and move on to the next step when the right time comes. Now, if you look at numbers wise, right, in the GTA, the average property that you're gonna buy is gonna be anywhere between $900 to $1.1 million, right? And some of those properties, honestly, they won't even have a second kitchen. There's no potential for a rental income. You're gonna be paying like a $5,000 mortgage. It's crazy, I know, but you can get within that budget a property that'll get you a second unit that you could probably rent out in Toronto, Mississauga, Brampton, up to $2,500. So that'll cover half your mortgage. In places like Hamilton, you can get a property with a second dwelling unit for around minimum of, I would say, $750K up to $850K. If you want something really nicely done, it'll be a little bit more. But same thing, you can rent the basement out in a place like that. You can rent the basement out for probably around $2,000, if not more. So if you look at the numbers of what it costs to get something with the second unit versus without, generally it's about $100 grand difference. That $100 grand is gonna cost you probably $400 monthly on a mortgage, and most people are gonna be financing, so they're getting a mortgage. So if you're putting 10% down, that's an extra $10,000 that you're putting towards the property. But you're getting 4 times the return because the rental income you're gonna get is probably around $2,000, if not more. So you can kind of see how that works in your favor. I'm gonna give you a bonus one, which is something that's recently been occurring in the last year or two, and a lot of my clients are doing this, which is basically a third unit. So now in a lot of cities such as Toronto, Hamilton, and other areas close to the GTA, you can actually put a third unit in your property in a detached garage. In some cities, they'll allow you to do it in an interior garage or anywhere on the property as long as you meet building code requirements. So if you do that, you're gonna severely reduce your costs. Obviously, most properties won't come like that, and especially in solid areas, you're not gonna find a lot of properties that have 3 units because it is a newer phenomenon. So these are properties where you will probably have to create that. And if you're looking to do something like that, get in touch with me. I'll leave my info below. So you can do something like that. And then what that does is it'll probably, like, if you have, let's say 3 units on a property, each of those units is probably renting on an average between $1,800 to, I would say, $2,200. You could pay off pretty much your whole mortgage and then you'd be living in 1 unit. So that's a plus if you really want to go that route, but obviously you'll need additional funds for something like that. Now, what I would say is you just have to think about it like clearly. If you are not willing to obviously negotiate, or you're not willing to come down and change preferences, then it's a different story. But I would say it's worth doing because you can use this as a stepping stone to build up equity, save some money every year, and prices aren't really going to change. Honestly, rates are at an all-time high, and my personal opinion, things are getting really tight, and the longer they stay here, the more people's renewals are coming up, the harder it's going to get. So at some point they will have to slightly come down at least a bit, which is likely going to be next year. So it's not like if you're buying something right now, you know, like even 2 years from now, things are going to be crazy, because I think we're in an environment right now where things need to kind of balance out rather than go up or down. So it's a safe play, and you don't have to go to bad areas. Like a lot of these properties, again, you can find in really good areas, A areas. If you have family, if you have kids, you're gonna have probably areas where there's good schools, good community. Even in newer houses, a lot of times this is possible, and a lot of people tend to do this. Like this isn't a new idea or anything. It's just that now more than ever, it's probably very important because just the offset that it brings to your monthly expenses is severe. So I would say, like, dealing with the high interest rate environment, you have a couple of options, right? You can either opt out, which it's gonna kind of put you outside of even having ownership. And then the other option is you can kind of tackle it by using a solution like this temporarily. Temporarily, I would say, like, commit to at least 3 years plus, because usually we find that any changes in the market or in the economy, there's cycles of like 3 years, maybe a little bit more. I mean, right now we're in, I would say, unprecedented times, but it looks like things will improve in the coming year. So use this as like a stepping stone, and then until you get to the next step. And then down the line, as you're paying down your mortgage, you're building up equity, you're putting aside savings from your rental income that you're getting. You can leverage all of that to go on to your next property. If you grow your family, or even if you're an investor, if you're looking to grow your portfolio, basically you're going to leverage that down the line as the economy improves, because that's probably when you can do a nice refinance, or even if you're looking to sell your property and just move up or invest into something else, you can use this for now, right? So definitely like take advantage of this and consider your options when you're getting into the market, or if you're an investor. And definitely reach out to me if you're looking in the Hamilton area or Niagara areas, even the GTA. I'll definitely give you some pointers, and I can tell you what the best course of action is based on your situation, because it might not work for everybody, but I would say in most cases, this is a pretty simple solution. Most people are aware of it, but I think people are forgetting how much of a difference this really makes nowadays.